firms are coming back, and the proverbial pendulum is swinging from ridiculously founder friendly to what I call more normal, like taking a board seat, 1x liquidation preferences. Someone this morning pitched me a company that they didn't want a safe, the investor, because then they couldn't get a markup. They couldn't mark it up book to book depending on a note or a safe, because a note is technically debt and you can value debt somewhat. We'll see caps, and safes are for future. So depending on semantics, you can't mark it up. But then they also, in the note, we're getting 5% interest or 10, 20% interest, which is almost like a ticking time bomb. Not that it would be too much dilution, that says, by this time, you should then do a priced round. Whereas if you were a hot company, you were just getting term sheets thrown at you. I've seen a lot of uncapped as well, just the ability to get in. And so this isn't a bad thing, as I'm saying, it's a reversion to the mean. This is what 10 years ago when I started in the tech scene was normal. You did a price preferred equity round. Yes, it was more documentation, a little bit more expensive, but you set a foundation. Things weren't as crazy. Everything was safes these days. You could raise millions of dollars on a safe, no accountability. There was so much money that's like, oh, it didn't work out, great, next one. Or if it's working, just try and get in and do a 10 million, a 20, a 50 million safe, because you can. And you know what? If you can raise the capital and people are investing, great. Just know the expectations that come with it. And so I think we're going to start seeing this. Hopefully nothing egregious. At the later stage,